Hello and welcome to your own channel. Let's talk business once again. Before starting this session, Merry Christmas and have a happy and successful year ahead. I'm recording this session almost after 7 months break. From last couple of months, I was extremely busy working with one of the fastest growing startup insurtech syndicate in Lloyd. Since it's a greenfield project, I was fully occupied and I was not able to record this session. I got some time now, so let's start talking business today. In this short video presentation, I'm going to cover an important subject called contract certainty, which is basically deal now, detail later to deal now, detail now. We'll talk about it. Now, in this session, we'll talk about what is contract certainty, why it is required, and what are the fundamental principles behind the contract certainty. So, as always, there is a lot to know and a lot to discuss. So, let's start talking business. For those who are new to this channel, I am Ravi Shankar. I am having more than 16 years of experience in the business analysis area, largely associated with P&C and general insurance domain. From last couple of years, I'm practicing in Lloyd's of London. If you have queries related to this video presentation or my previous video presentations, do reach me at my Hotmail ID. I'm also available at LinkedIn and I'm also available at Twitter. So it's up to you where you want to reach me. Once again, thanks a lot for all your emails and all your responses. I really love them all. So what is contract certainty? Now the objective of the contract certainty is to provide clarity to both the customer and the insurer on the terms and condition of the policy prior to the inception or renewal. It's very important, right? Both of these parties should be totally aware about what they are agreeing, and it is important for both of them. The full wording must be agreed before any insurer formally commits to the contract. That is point number one. And the appropriate evidence of the cover is to be issued within 30 days of the inception for the commercial customer and within the 7 days for the retail customer. This has become an acceptable definition throughout the UK insurance market and has been noted and agreed by the FCA, Financial Conduct Authority. Now, this might look very simple on the face of it, but actually it's not very simple as you think. It is complex subject, and that's the reasons, right? Since 2004, the regulators in UK FCA or PRA is having a very close eye on it. As you know, the London market had historically been very focused on developing innovative insurance solution, and sometimes the market is slightly less focused on the documenting of this detail of this contract. Now, since there is a very less documentation, it is sometimes very difficult for you to fully understand the contract, especially during the time of claim. Now, just think, right? You are actually handling a claim and you are not entirely clear what is covered and what is not covered, or in a similar condition, right, handling an insurance dispute where both the parties are more likely to have a different interpretation of what they have bought or agreed initially. So just to avoid this terms and condition, or just to avoid this confusion, right, you need a contract certainty for sure. Now let me give you some quick background why it is required and why regulators started focusing on the contract certainty. And it actually rooted back to 2001 when 9/11 attack happened. The event of 9/11 completely changed the way we think about the insurance, and there was a confusion about what cover has been provided for the Twin Tower at the time of the attack. You will be surprised to know that by September 11th, there was no formal wording has been agreed, and there was only or merely temporary contracts and the promises to provide the insurance coverage, and then that's it. There's no formal document. After the Trade Center collapse, the leaseholder Larry Silverstein claimed that there has been two events based on two plane strikes, while the insurer and the reinsurer argued that there has been only one event based on the single coordinated terrorist attack. Can you believe it? Can you understand why it is important to have a clear definition within the insurance contract about the event of the claim? Now, this debate set a stage for the insurance market to take contract certainty very seriously. Now, at the beginning of 2005, there was a lot of change happen in the UK insurance market or London market. The regulator at that time, FSA, now it is changed to FCA, Financial Conduct Authority, took charge of the general insurance business and recognizing the need of standardization and security in the insurance industry, which is actually known for their informal practices and methods. And the FCA gave a market an ultimatum to change it, to have better clarity in their operation. And if they fail to meet this objective, the FCA will impose their own rules and regulations. Now, what happened after that? The several effort was made to reform the business process around the contract certainty, and there was a several group established, and one of the premier group was Market Reform Group, and this group was consist of many individual subgroup, which is London Market Association LMA, London Market Brokers Committee, International Underwriting Association IUA. So there was a many group. They came together to put some effort in order to achieve the contract certainty. Well, that's a brief background about the contract certainty. Let's move ahead and let's see what is contract certainty and why it is required, and what is the central aim behind the contract certainty. Now, if you see here, the contract certainty is essential to minimize the risk. Risk applies to the underwriter and the broker. The underwriter are affected because they are uncertain with the regard of their exposure, while the broker are exposed to the E&O, error and omission claims, right, when the writing or the contracts are poorly crafted. Now, the second important part, uncertainty over exposure for underwriter leads not only to reserving risk but also inability to understand the business performance properly. Now, the third important problem is to avoid the delay in negotiation and legal dispute. Now, lack of contract certainty leads to delay in negotiation and legal dispute, and this generates a higher cost and slower movement of cash. Finally, the lack of contract certainty means that the policyholder do not have clarity on the coverage when they purchase the insurance coverage. So what is the central idea behind the contract certainty? Now, the thing is pretty fair and straightforward: to provide certainty regarding the contractual terms, ensure the certainty of the coverages, minimize dispute, reduce time wastage, and reduce the legal bills. So these are the central idea behind the contract certainty. Let's talk about the principle of the contract certainty, which is very, very important. Now, the first principle talk about when you are entering into the contract. So the insurer and the broker must ensure that all terms are clear and unambiguous by the time the offer is made to enter into the contract, or the offer is accepted. All the terms must be clearly expressed, including any condition or subjectivities. The second principle talk about after entering into the contract. Now, the contract documentation must be provided to the insured promptly. Now, the contract documentation contain all the agreed terms and condition and the contract between the insured and the insurer and the details of it. The insurer must provide the contract documentation to the insured. As I said earlier, if the insured is a consumer, then within 7 working days, and if other than consumer, within 30 working days. Now, the principle C actually talks about the demonstration of the performance. Now, the insurer or the broker must able to demonstrate that they have achieved the principle A and B. Going to the principle D, which is in respect to the contract changes, or you can say that the endorsement on the insurance contract, the insurer and the broker must able to demonstrate that they have achieved the contract certainty even at the time of endorsement, just like point A, B, and C, or principle A, B, and C. The next two, E and F, when entering into the contract and after entering into the contract, is actually related to the situation where there is more than one insurer participating in the risk, or you can call it as a subscription basis. So the contract E, or the principle E, talks about when entering into the contract must include an agreed basis on which the insurer final participation will be determined. This is basically to ensure that the method of calculating the insurer participation or sign line is clearly stated in the contract. If you are going to stay on the line, you must mention that line to stand in order to avoid any confusion. And this is achieved by inclusion of signing provision. Then after entering into the contract, the final participation must be provided to the insured participating in the risk promptly. The last principle, G, is talking about the situation where the contract is not met with the principle. At the time when the contract is not met with all the above principle, the insurer and the broker have responsibility to resolve any exception to any of the above principle as soon as possible without any delay. Going forward, let's see some of the sample checklists which help them to achieve the contract certainty. These are just a sample, right? In the Lloyd's website, you have a QA tool, and that QA tool will help you to actually get all the list of questions which you can able to use to achieve the contract certainty. Let's look at some of the basic questions, like all the parties to the contracts are clearly identified. Is the period of the cover is clearly expressed? Are the sum insured or the limit is clearly expressed? The premium or the rates are clearly expressed, or if there any reduction applies is clearly expressed? Are there any payment terms which requires some sort of a clarification. Say, for example, if the payment is on annual basis, monthly, or quarterly basis, does the contract contain the reference wording? If yes, then you must provide the reference wording in detail. Any provision for the notification and agreement of the claim is clearly expressed. Does the contract define the applicable law and jurisdiction? Does the signing provision achieved or clearly defined by all the participation? And then the several liability is clearly expressed. Now, what is this several liability clause, right? I picked up this particular cutout from the binder agreement itself. It says that the liability of the underwriter is several and not joint, and is limited solely on the extent of the individual proportion. The underwriter are not responsible for the subscription of any co-subscribing underwriter or any other insurer or co-insurer who for any reason does not satisfy all part of its obligation. So several liability says that I am responsible for only my part of the business. Well, that's all about the contract certainty. I hope you have gained some knowledge from this video presentation. Goodbye and take very good care of yourself during this pandemic time. Bye bye, and I will see you soon in next video presentation. Bye bye and take care.